I want you to listen carefully, because what you are watching unfold is not a price chart. It is a behavioral event, a psychological compression chamber where belief, fear, and supply collide. This is how every real monetary break begins, not with celebration, but with disbelief. This move in silver did not come out of nowhere. It never does. Markets do not wake up one morning and decide to reprice reality. They rehearse it in silence. They condition participants through boredom, false breakdowns, engineered relief, and exhaustion. Then, when positioning is wrong and confidence is thin, the move happens so fast it feels supernatural. I called this move not because I am prophetic, but because the structure was familiar. I've seen this pattern repeat across centuries of monetary stress. When confidence in paper claims expands faster than trust in institutions, hard assets do not ask for permission. They disappear. That word matters. Disappear. When silver goes silent at the physical level, that is not a rally. That is a withdrawal. That is inventory stepping back from price discovery. It is producers, refiners, and holders refusing to participate in a market that no longer reflects scarcity. Futures can print anything they want in that moment. The real signal is absence. History is very clear on this point. Every monetary transition is preceded by a phase where quoted prices diverge from obtainable supply. The price looks calm or even weak, while delivery times stretch, premiums rise quietly, and wholesalers stop returning calls. The public does not see it because the screens still work. But beneath the surface, metal is already voting. This is where psychology turns brutal. Retail is taught to worship confirmation. They are trained to wait for headlines, for analyst upgrades, for safe narratives. By the time those arrive, the metal is gone. What remains is exposure to paper promises and a rising sense of panic. The move everyone sees is always the second move. The first move is withdrawal. The second move is repricing. The third move is regret. Now, the question everyone is whispering is whether this is the bottom or whether the market will retest lower. That question itself reveals the conditioning. People want symmetry. They want fairness. They want the market to behave like a classroom lesson. Real monetary assets do not behave that way during regime shifts. When silver is allowed to fall despite tightening physical conditions, that is not weakness. That is a psychological operation. It is designed to shake out late belief and reward early conviction. The market tests who understands the difference between price and value. Retests happen when confidence is still high. Violent upside gaps happen when confidence is gone. Look back at every historical moment where silver mattered again. Not as an industrial input, but as a monetary barometer. The same sequence repeats: long suppression, public boredom, a sudden narrative shock, physical strain. Then a move so fast that the debate about entry becomes irrelevant. What matters now is not where price ticks tomorrow. What matters is whether metal continues to vanish at current quotations. If supply does not reappear, lower prices become less likely, not more. Markets cannot sustainably fall when sellers refuse to sell. But there is another layer most people miss. Silver is not moving in isolation. It is responding to a credibility problem. When debt expands without consequence, when currencies rely on confidence rather than discipline, and when institutions signal control while losing it, silver reacts early. Not loudly, early. This is why the move feels uncomfortable. It is not being celebrated, it is being argued with. That is how you know it is real. The loudest voices right now are not asking whether silver is scarce. They are asking whether the market will give them another chance. That is the sound of a transition already underway. You do not need to predict the next tick to understand the phase. This is the phase where paper markets attempt to reassert dominance over something that no longer wants to be priced that way. Sometimes they succeed briefly. Sometimes they trigger the very breakout they are trying to suppress. The danger is not buying too high. The danger is mistaking a psychological test for a fundamental reversal. Silver does not ring a bell when it is done testing patience. It simply moves on without you. And when the public finally agrees that something has changed, the physical metal is already in strong hands, the price is no longer negotiable, and the conversation shifts from whether to buy to why it was impossible to find. The silver move was not a rally in the traditional sense, because rallies are emotional releases. They are moments where enthusiasm spills out into price and the crowd feels rewarded for participation. This was something colder, quieter, and far more revealing. It was a psychological event where the visible price attempted to tell one story while the physical market told another. And when those two narratives diverge, history shows that the screen is usually lying. In a normal rally, supply responds. Sellers appear. Inventory comes out of hiding. Price discovery works because participants believe the price is fair enough to transact. What happened here was the opposite. As the paper price moved, the physical market did not engage. Metal did not flood the system. Instead, it pulled back. Dealers widened spreads. Availability thinned. Delivery times stretched. This was not excitement. This was refusal. That refusal matters more than any candle on a chart. It signals that holders of real silver no longer recognize the quoted price as representative of value. When that happens, the market enters a dangerous phase where paper contracts can still be traded freely, but the underlying asset becomes increasingly abstract. Price continues to exist, but substance begins to disappear. This is not new behavior. It is a recurring feature of stressed monetary systems. Whenever confidence in financial structures weakens, tangible assets begin to behave defensively. They do not rush higher immediately. First, they go quiet. They retreat from circulation. The silence is mistaken for weakness by those trained to watch only screens. Paper markets are excellent at manufacturing reassurance. They offer liquidity, speed, and the illusion of depth. But they rely on belief, the belief that contracts can be settled, the belief that inventory exists somewhere, waiting patiently, the belief that if everyone showed up at once, the system would still function. Psychological events expose how fragile that belief really is. In this silver move, the futures market attempted to assert control through price signaling. Lower quotes suggested abundance. Volatility suggested uncertainty. Technical narratives suggested caution. Yet the physical market refused to validate any of it. Scarcity does not announce itself with sirens. It shows up as inconvenience, as delays, as excuses, as silence. This is where psychology becomes the primary battlefield. Most participants are conditioned to equate falling or stagnant prices with reduced risk. They are taught that markets become safer as they become cheaper. But in physical commodities, especially monetary metals, the opposite can be true. A lower price can increase risk if it accelerates withdrawal. When physical supply withdraws, the market becomes thinner, not stronger. Each remaining unit carries more informational weight. Each marginal buyer matters more. The system becomes more sensitive, more unstable. It looks calm until it is not. The denial of scarcity is not accidental. It is structural. Paper markets exist to smooth perception, to distribute stress over time, and to prevent abrupt repricing. They work remarkably well until they do not. Their weakness is that they cannot manufacture metal. They can only reference it. As long as participants accept references instead of substance, the system holds. When enough participants begin to question whether the reference still maps to reality, cracks form. Those cracks do not show up immediately in price. They show up in behavior. Watch behavior, not commentary. When wholesalers stop advertising availability, when large bars quietly change hands off screen, when retail premiums rise even as quoted, prices stagnate. These are not anomalies. They are symptoms of a market where the physical layer has emotionally detached from the paper layer. This detachment creates cognitive dissonance. Analysts debate whether the move is real. Traders argue over support and resistance. Commentators call for confirmation. Meanwhile, metal moves into stronger hands. The people least interested in short-term price become the dominant holders. This is why calling it a rally misses the point. Rallies invite participation. This event discouraged it. It confused it. It punished impatience and rewarded conviction that had already been formed. It forced observers to confront an uncomfortable truth. Price is not always discovery. Sometimes it is delay. The denial phase is always loud. The absence phase is always quiet. By the time scarcity is acknowledged publicly, it is no longer actionable. The market has already transitioned from distribution to protection. Silver has always behaved this way during moments of structural stress. It waits. It allows narratives to exhaust themselves. It allows confidence to decay slowly. Then, when the paper structure is leaning too heavily on belief, it stops cooperating. At that point, the question is no longer whether the price was fair. The question becomes whether the price was real. And once that question enters the collective psyche, the move stops being about charts and starts being about trust. When trust fractures, silver does not need momentum. It only needs absence. That is why this move matters. Not because it was dramatic, but because it was quiet. Not because it convinced everyone, but because it did not need to. It revealed a gap between perception and reality, and those gaps, once opened, rarely close gently. The real risk is not a lower retest on a screen because screens are designed to manage emotion, not truth. They flash numbers, redraw lines, and invite interpretation, all while creating the illusion that control still exists. The deeper danger lies in confusing those movements with reality itself, especially when the structure that once anchored price to trust begins to fracture. When that fracture appears, silver does not negotiate. It does not wait for confirmation. It stops asking for permission and simply reprices. Most participants are trained to fear drawdowns, pullbacks, and retests. These are familiar risks, risks that can be modeled, hedged, and debated. They belong to a world where markets remain orderly and rules still apply. But structural risk does not announce itself through volatility alone. It emerges when the mechanisms people rely on to interpret value no longer function as expected. Paper price action is a language, and like any language, it depends on shared belief. Futures, options, and derivatives only convey meaning if participants trust that the system behind them is coherent. When trust is intact, price movements feel informative. When trust erodes, price becomes performative. It continues to move, but its message is distorted. Silver occupies a unique position in this dynamic. It exists simultaneously as an industrial input, a monetary metal, and a psychological hedge against disorder. Because of this, it is deeply sensitive to trust. Not optimism, not growth, but trust. When institutions are credible, silver can remain dormant. When credibility weakens, silver becomes alert. A lower retest on a screen suggests patience. It suggests that the market is still engaged in negotiation, still offering time to decide. It invites analysis, debate, and strategy. Structural breakdowns do not offer that courtesy. They reveal themselves through behavior, not price patterns. One of the most dangerous assumptions investors make is believing that price always leads reality. In stable environments, that is often true. In transitional environments, reality leads price, sometimes by a wide margin. The screen lags. The physical world moves first. When silver begins to reprice structurally, it does not do so in response to technical signals. It responds to withdrawal of trust in currencies, withdrawal of confidence in settlement, withdrawal of willingness to exchange a finite asset for an expanding promise. This is why focusing solely on paper action can be misleading. A chart may show weakness while physical availability tightens. Volatility may compress while risk expands. These contradictions are not errors. They are symptoms of a system under strain. Repricing is not the same as rallying. A rally assumes continuity. It assumes that after the move, the system remains fundamentally unchanged. Repricing implies regime shift. It implies that the old reference points no longer apply. Silver does not reprice because it is excited. It reprices because the measuring stick has warped. When trust breaks down, markets seek anchors. Silver has served that role across centuries precisely because it is not dependent on belief to exist. It does not promise. It does not yield. It does not require enforcement. It simply is. That quality becomes threatening in systems built on leverage and confidence. As long as silver can be persuaded to behave like a financial asset, it remains manageable. When it begins to behave like a monetary one, it becomes uncontrollable. This transition is subtle at first. It looks like inefficiency, like mispricing, like temporary dislocation. Commentators argue that arbitrage will resolve it, that supply will respond, that the system will correct itself. These arguments assume that participants still want to play by the same rules, but repricing occurs when participants opt out of those rules. When holders of silver decide that the compensation offered by the system is no longer sufficient, they do not short the market. They do not protest. They simply stop engaging. At that point, paper prices can fall, rise, or stagnate without resolving the core issue. The issue is no longer price. It is credibility. Once credibility is questioned, the market shifts from exchange to protection. This is the moment when silver stops asking for permission. It does not wait for central banks, regulators, or analysts to validate its role. It responds to the collective subconscious realization that something fundamental is misaligned. Those watching only the screen see noise. Those watching behavior see signal. They notice who is no longer selling, who is no longer advertising, who is quietly accumulating without concern for short-term moves. The real risk, then, is not missing the perfect entry after a retest. The real risk is being anchored to a framework that assumes the system will always grant you another chance. Structural breakdowns do not operate on schedules. They resolve abruptly. When silver reprices under these conditions, it does not care who is ready. It does not care who is skeptical. It moves to a level where trust and reality are temporarily reconciled. By the time that happens, the debate about charts becomes irrelevant. The only question left is whether you understood the difference between a market fluctuation and a loss of faith. Every major silver repricing follows the same pattern because human behavior does not evolve at the same speed as financial systems. Technology changes, platforms change, instruments change, but psychology remains stubbornly consistent. Silver sits at the intersection of money, trust, and denial, and that is why its major moves are never random. They are rehearsed over long periods of suppression, executed during moments of disbelief, and finalized through absence and shock. The first phase is always suppression, and it is never purely mechanical. It is social. It is narrative-driven. Silver is framed as boring, obsolete, overly abundant, or purely industrial. Attention is diverted elsewhere. Capital is encouraged to chase innovation, growth, leverage, and yield. Silver is left behind intentionally, not because it lacks value, but because its value challenges the structure that benefits from excess confidence. Suppression works best when it feels justified. Prices grind sideways or lower for years. Volatility dies. Coverage disappears. Analysts stop caring. The public learns to associate silver with disappointment. This emotional conditioning is critical. Before silver can reprice higher, belief in its relevance must be broken first. A market no one loves is easier to control than a market people believe in. Then comes disbelief. This phase begins quietly. Something shifts beneath the surface, but it does not align with the dominant narrative. Economic stress increases. Currency credibility weakens. Debt expands faster than productivity, yet silver remains unmoved, or worse, continues to fall. This confuses observers. If silver is supposed to be protection, why is it not responding? That confusion is not accidental. Disbelief is the bridge between suppression and repricing. It forces participants to question their own frameworks. Some abandon silver entirely, convinced it no longer works. Others hold reluctantly, constantly second-guessing. Confidence erodes even among believers. This is exactly the psychological environment required for the next phase. Physical disappearance does not announce itself. It never does. There's no headline that says metal is leaving the system. Instead, there are small frictions. Coin shops have less inventory. Bars carry higher premiums. Delivery takes longer. Large buyers transact quietly. Refiners prioritize long-term relationships. None of this looks dramatic on a chart, but it changes the structure of the market. This is where the paper and physical markets begin to diverge. Futures can still trade freely because contracts are abstractions. They are claims, not objects. Physical silver, however, responds to incentives differently. When holders believe price no longer compensates for risk, they stop selling. They are not bullish. They are defensive. They are opting out. Opting out is more powerful than buying. Buying requires belief. Opting out requires distrust. When enough holders distrust the pricing mechanism, supply contracts regardless of demand. The market becomes hollow. It can still move, but it has lost depth. Public disbelief peaks here. Commentators dismiss shortages as temporary. They blame logistics. They cite substitution. They argue that if silver were truly scarce, price would already reflect it. This circular logic keeps people anchored to the screen, waiting for confirmation that can only arrive after the move is over. Then comes the violent move. It is violent not because it is irrational, but because it is compressed. Years of suppressed pricing, misallocation, and disbelief resolve in a short window. The market realizes all at once that the available supply at previous prices no longer exists. Bids chase offers that are no longer there. Gaps appear. Volatility explodes. Explanations scramble to catch up. Late participants experience this as chaos. They feel blindsided. They look for entry points that never come. They wait for pullbacks that do not materialize. What they do not realize is that the opportunity existed during boredom, not excitement. During ridicule, not headlines. This is where silver is most unforgiving. It does not distribute opportunity evenly. It concentrates it in periods where conviction is hardest to maintain. Those who endured suppression and disbelief are not rewarded gradually. They are rewarded suddenly. Those who waited for safety are left negotiating with scarcity. The pattern repeats because it reflects a deeper truth about monetary stress. Systems that rely on confidence resist repricing until resistance becomes impossible. Silver, sitting outside the promise structure, responds last and then fastest. It absorbs disbelief until disbelief collapses under its own weight. Every cycle ends the same way. After the move, silver is rediscovered. Narratives flip. Analysts rush to justify what has already happened. The public asks why no one warned them. But the warning was always there. It just did not sound like excitement. It sounded like silence. And silence, in markets like silver, has always been the loudest signal of all.